Chapter 11, Investment Analysis and Taxation of Income Properties. In this chapter, we'll discuss a variety of things, but mainly we're going to be focusing on looking at an office property example where we develop the cash flow first when there is no debt, then we add debt to the example, and then we add taxes. And in each case, we're going to look at the IRR and the NPV. In other words, a few investment decision techniques. A couple of things to pay important attention to as we go through. One is developing all of the NOI for the office building, because that will be your next spreadsheet project. So you want to make sure you understand when we go through this example how they develop the cash flows for this office building with the 3 tenants and the leases that are there. So we'll go through that. That's one part. And the other is making sure that you understand the effect of debt and the effect of taxes on these cash flows so that you can calculate the BTIRR, the before tax IRR, and the ATIRR, the after tax IRR. And we will calculate both these numbers, one when we have debt and one when we don't have debt. Okay, so we begin by discussing, as we're talking again about income-producing properties, what are some of the motivations for investing? And they're not much different than you'd find with any other type of investment for stocks or bonds. We're looking for a rate of return. We're looking for price appreciation, for the value of the property to go up. We're looking to diversify. So if we own a lot of stocks or bonds, we're looking to diversify into real estate. And one thing that real estate particularly has is tax benefits. So that's one important reason we understand the way that we can benefit from taxes with an investment in real estate. I'm not going to go through each of these investment strategies. There's a couple of pages in the book where they describe them, but basically if you think about it, it really isn't very different than stocks. If you look, they have contrarian investing, market timing, size of investment. So do we have big cap, large office building as we have big cap stocks, or small properties? Do we have properties that we think are in a certain niche? Are we just using office buildings in an urban area, or are we using apartments in a rural area? Whatever it may be, we might do niche, just apartment buildings and so forth. We're just going to use blue chip properties like blue chip stocks with high quality tenants inside. So very similar, different strategies that may be used for investing in investment properties. So to make the investment decision, we have a number of steps. Okay, we need to forecast what the cash flows will be from the operations and forecast what the cash flow from the sale will be. And then we need to determine the present value of those expected cash flows using whatever our required rate is. So whatever we require as a risk return rate for this property, we would use that to discount the cash flows, and then we'd apply some kind of investment decision criteria. So for those of you who haven't taken capital budgeting, you might need to pay a little more attention. If you've taken capital budgeting, it's just applying. In this case, we're just going to look at the net present value and the IRR techniques to make an investment decision. Forecasting the cash flows from operations. To do this, we'll need to forecast the potential gross income, the effective gross income. The difference between these is vacancy. Okay, the effective gross income takes into account vacancy where the potential does not. Then we will remove the operating expenses to get our net operating income. And then if they have any non-recurring expenses, those would be removed. And by this we mean something that is not going to keep happening every week. We have to redo the roof. Hopefully we wouldn't end up having to do it again for another 20 or 30 years. We have to pave the driveway again. We're not going to be doing it over and over again every year. Things of that nature. So here's what a calculation would look like, and some of the symbols that the book uses: the gross potential income minus any vacancy and collection losses, and adding any other miscellaneous income, such as the example we looked back further in the apartments. I think it was the last chapter where there was a laundry. Okay, so they had some miscellaneous income from that. It gives you the effective gross income. In this particular chapter, we'll have income that comes in from reimbursements. That will be up there in the potential gross income. That gives us our effective gross income. We'd subtract out our operating expenses and we get our NOI, our net operating income. And now it's the same calculation with some numbers. So you can look through this. And then, of course, we would carry that out not only for 1 year, but for every year of our holding period. So in this particular example, their holding period is 5 years. So they've gone through and calculated the potential gross income, subtracted out the vacancy and collections, got the effective gross income, subtracted out the operating expenses, and they've got the NOI for 5 years, which would be the holding period for this particular investment. Then, as we mentioned, the other forecast would be the forecasted cash proceeds from the sale. So a variety of ways you'd come up with a sale. Generally, the most two common are take the next to last, so if it's a 5-year holding period, take the 6 years NOI and divide it by the terminal cap rate. Another common way is to take what the price is that you're going to pay for this building and say, well, we assume that it's going to grow at 3%. So if it was, say, $1 million building and you grew it at 3% for 5 years, it'd be 1 million times 1.03 to the fifth. Okay, and you just appreciate that building at 3% for 5 years. So in this case, they appreciated the building to $1,026,000. They assumed there'd be selling costs of $51,300, and then they have net proceeds, cash proceeds that they would get from the sale here of $974,700. Okay. And remember, in this example we're looking at, there are no taxes and no debt. We're not incorporating that at this point. So we don't have to subtract out any mortgage balance, and we are not subtracting out at this point any taxes. This is all before tax cash flow. The next thing we need to do is make an investment decision. Okay? So one of the ways we'd make an investment decision is say, well, what's the present value of all these cash flows we just projected at our required return? So if they said the present value of these cash flows at 12%, and they calculate that, and they say that it's $891,846. Okay, so that's what they're saying. If we paid that for this building and get these projected cash flows for operations and for the terminal sale, we would then get a 12% return. So anything below that amount, $891,846, would give us a higher than the 12% return, which would make this a more favorable investment. The official name for this technique is called the net present value, or NPV. The net present value is the present value of all the project's cash flows minus the present value of the cash outflow. Okay, so the outflow here would be what we had to pay for the building. So we calculated back there was $894,000 some odd cents was the present value. So if we could subtract off the price we'd have to pay for the building, say if it was $850,000, then we'd have a positive number. And if it's a positive NPV, we say we should go ahead and buy the building. It would be a good investment. If the NPV comes out negative, we would reject the building, reject the investment. So in this case, we say the building was up for sale for $885,000. So we incorporate that into our calculation. So we still discount back all of the cash flows from operations from the sale at 12%. But then once we get that number, we subtract out the $885,000, and we end up with a net present value of $6,846. So it's a positive value, not extremely positive, but it's a positive value. So we'd say that this project could be accepted. The IRR, we just take these cash flows, the cash outflow of $885,000, and then the cash inflows, $79,554, and so forth, and we solve for the IRR, the internal rate of return, and we find in this case it's 12.2. Okay, and the next slide will give us our criteria for accepting or rejecting with an IRR. But if the IRR is higher than the required return, it would be an accepted project. So we see in this case the IRR is 12.2. The required return is 12, so it's higher, so we would accept this project. One thing for those of you who have not taken capital budgeting to recognize is if we accept the project by either technique, the other one will also agree. So in other words, if you find a positive NPV, you should also calculate an IRR that's higher than the required return. Vice versa. If you calculate a IRR that's higher than the required return, when you calculate the NPV, it should be positive. If not, you've done something wrong and you should check your numbers. So here's a decision criteria for this investment. These investment techniques written out: if the NPV is greater than 0, then the project exceeds the investor's required rate of return, and we could accept it. If it's less, it does not meet the required return, we would reject that project. If it's equal, we'd basically be indifferent. And the internal rate of return, by definition, it's that rate of return when the NPV is equal to 0. So if we set all the cash flow inflows equal to the cash outflow, the present values, what rate makes the present value of all those cash flow equal to the cash outflow? That's the internal rate of return. And the decision criteria with the internal rate of return is that the internal rate of return is greater than the required rate of return, except if it's less than the required return, we reject. If it's equal, we're basically indifferent. The NPV and IRR, if we have some discussion about the two of these, there's one of the key differences between these is how the cash flows are assumed to be reinvested. With the NPV calculation, we assume that all cash flows that come out. So if we notice in this project, we had about $79,000 coming out the first year, then $80,000 and so forth. As those cash flows come back out, we're going to reinvest them. We're going to reinvest them, put them back to work for us. The assumption with the NPV is that they're reinvested back at the required return or more, but we say it's the required return. In reality, we could get more than that, and we hope we'll get a little bit more. With the IRR, it's assumed it goes back in, gets reinvested at the IRR of that particular project. So if you're looking at a project that's giving you an IRR of 20%, as some of these projects we look at in these chapters, where the company only requires 12%, that can be a little misleading, and it can lead to some wealth maximizing ranking problems. You will still get the same decision, reject or accept, with the NPV or IRR. But if you have done this and you've got 10 buildings and they've all been accepted, and now your decision is, I can only take 5 of those buildings, and you've got to decide which 5. Your better method is to use the NPV to make this decision rather than the IRR, because of this reinvestment assumption that it can be misleading. The higher the IRR, the more misleading it gets, because the cash flows are being reinvested at this higher return. Also, with the IRR, if there are cash flow sign changes, meaning that in the first year, say you have an outflow, second year an inflow, third year an inflow, fourth year, all of a sudden there's another outflow. Then it goes back to an inflow. So in other words, we had positive, 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 then a negative outflow, positive again, and flipped back and forth. When that situation occurs, we may get multiple solutions with an IRR. There are some ways that we can kind of overcome this, and we will look at that in the capital budgeting course. But we'll just give you a little background for right now on these two. So if you're making, and we aren't even going to get into this in this course, but when you do talk about it in the capital budgeting course, remember the major difference between the net present value and the IRR is the assumption of reinvesting the cash flows. And because of that if you're making a ranking decision on which of 2 acceptable projects, or 2 or more acceptable projects are better, the NPV is a better method. Now we're going to look at the office building example. So I've listed here some of the pages that I'm getting the information, and I have cut and pasted these into the slideshow here, and pay particular attention on how these numbers are developed so that they can help you, and you might want to go back and refer to this when you're doing your spreadsheet project. Okay, the example here is an office building. It's being offered for $8.5 million. Right now there are 3 tenants in this office. You'll notice in your books there's a typo. The mortgage broker should have 16,000 square feet. If not, it would add up to 86,000 instead of 96,000, and the whole rest of the problem would be thrown off. So that mortgage broker square footage should be 16,000. So given the square footage of each of the 3 tenants, they're giving you what they're paying for rent, 14 for the bank, $14.50 for the law firm, and $15 for the mortgage banker. And they're telling you, so then you just multiply square footage times the rent per square foot, and we get the base rent. And then it tells you how many years are left in their lease, and that there is a CPI adjustment for 50% of CPI. They also let you know some other additional assumptions. The current market rent is $15 a square foot. The leasable square feet, which we just calculated, is the 96,000, so that right now there is no vacancy. The projected increase in market rent every year is 4%. Management costs are a percentage of the effective gross income, and they expect that to be 5%. That would be to manage the building, property managers. Estimated annual increase in consumer price index, the CPI, is 4%. And again, remember, we're assuming that there's a 50% pass-through. Also, we would assume that when the leases renew, they will renew at the current market rent, which is $15 now and will increase every year by the 3%. There are stops built into these leases, and they give you the stops for the bank, the law firm, and the mortgage firm. And they make the assumption that when the lease renews, the new stop becomes whatever the expense is worth for that current year. They also assume that vacancy, it will be 5% of base rent beginning in the 4th year. So it's nothing until that point. Now we can use this information to develop our projected base rent and CPI indexes. I'll put a couple of numbers in here to show you how they arrived at them. Example for the bank for the very first year. $14 a square foot is what they're paying, and they have 70,000 square feet out, so 14 times 70,000 gives you the $980,000 there. The bank in the 4th year. The bank has 3 years left on its lease. So in the 4th year, it needs to renew. So the way they get that number, the $1,181,107, is they take the market rent today, the $15, and they have to grow it 3 years at what they expect market rents to increase at, 4%. So it's 15 times 1.04 to the third. That will give you the market rent in the 4th year. And then they multiply that times the 70,000 square feet that the bank is renting. And that's where they get the $1,181,107. Okay. And you'll see the law firm, again, it's just whatever their market rent is, $1,450 times the square feet they have, and then in the 5th year they renew. So again, you take the $15 market, and for the law firm in the 5th year, it would be 1.04 to the 4th times whatever number of square feet they have. Then we come down to the CPI adjustment. Okay, well, the CPI, they said CPI is going to increase 4%. It's going to be a 50% pass-through. So we're going to get a 2% increase. So for the bank for the first year, you'll see they take the $980,000 times 0.02, a 2% increase, and that's $19,600. Okay. Now the next year's CPI, and to get that, they take the 19.6, okay, plus the 980,000. Okay, so the bank CPI for the last year, what that adjustment was, plus their base rent, 980,000, and they multiply that number, the sum of those two numbers, by 0.02, and then they have to add to that the 19.6 that was already there. And if you do that, you'll come up with 39,592. And then they do that each time. So now the next year, for the third year for the bank, you've got the $39,592 plus the $980. Okay, so that's the total amount they're paying the end of the second year. So they add those together times 0.02 to get the increase. But then you have to add back the $39,592 that they already had added on. And then you see in the fourth year for the bank, it's zero. Because in that year, that's the year that they renew their lease, and they just pay their base rent. Okay, and then the totals below, they just add the base rent for each to the CPI index for each, and they get the total rents for all the tenants once they sum those together for each of the 6 years. And we're looking 6 years out because it's a holding period of 5. We're looking 6 years out to see if we need to use the NOI in the 6th year to calculate our terminal value, our sales value. The next thing we need to do is come up with our reimbursable expenses, our operating expenses. And we were given what's in the very top, panel A of this. And they gave us what the dollar amount of property taxes, insurance, utilities, janitorial, and maintenance were currently. And then we divided those numbers by 96,000 to get the per square foot. And then they gave us projections for what would happen in the future. So for property taxes, if we look down below where we're doing the projections, they gave us 2 years, level for 2 years, 10% increase, then level. So if we look at property taxes, we see we use the number they gave us, $148,008 for 2 years, because they said it would be level for 2 years. Then we take that $148,800 and increase it by 10% by multiplying it times 1.1. We get $163,860, and then we see it stays level for the rest of the time, as the projection indicates. Then we have others like insurance, which just start at $14,400 and increase 4% a year. So just take the prior years, multiply it times 1.04, and you go all the way across. Okay. Then we add all of those expenses up to get the total operating expenses. Okay. And we've already done the first year, so let's look at the second year. We end up with the second year, the total operating expenses, $438,096. And we're going to need, though, the per square foot number to see if we have to get reimbursed for our expense stops. So we divide that $438,096 by the $96,000, and we see the per square foot expenses for the second year are $4.56. Okay. So in the third panel here, we now work at looking at what should be the projected expense reimbursement per year. So for example, for the bank for the first year, their expense stop is $4. The expenses for the year were actually $4.45 per square foot. So $4.45 minus the $4 stop, 45 cents, times the number of square feet the bank leases, 70,000, gives you 31,500. Okay? And that just continues all the way across. So for the bank for the second year, it's $4.56 minus their $4 stop times the 70,000 square feet. Okay? And this continues up until the point when you get to the fourth year. In the fourth year for the bank, that's when the lease is renewing. So at that point, we renew the lease. We go to market rent, as we did in the last panel. But now the expense stop becomes $4.96, because that's what the expenses were in that year. So for the next year, okay, for in the fifth year, we'd say, well, the expenses were $508 minus the $495 for the stop. You take that number and you multiply it times the number of square feet, 70,000 square feet, and you get 8,979. Now they carry these calculations out 4 decimals. So if you only carry it out 2 decimals, it'll be a little bit different, but it won't be a huge, big difference. Okay. And you see the law firm, same way. Calculate that across until the fifth year, when again the lease renews, so the expense stop becomes that year's expense stop. So there is 0 to pay for reimbursement. Then we put these together to get the NOI. So we've got the base income, Then we add the CPI. These are in total, all three tenants. Then we add the reimbursements, and we get the total potential income. Then we say less any vacancy. Now you'll see the first 3 years there is not any. In the fourth year, though, we assumed that it would be 5% of the potential income. So 5% of this case of the $1,608,600, and you see that that comes out to be $80,400, and that would be the vacancy in the fourth year, and that continues. Then we subtract the vacancy from the potential income to get the effective gross income. Then we subtract out the reimbursable expenses, the total dollars, because we already added above the reimbursements. And then we subtract out the non-reimbursable expenses. Okay. And the only one that they mentioned here would be the management expenses. Okay. Those are paid directly to management, and they did say those would not be paid by the tenants. And those were 5% of the effective gross income. So you take 5% in the case of the first year of $1,421,000, and you get $71,050, and that's the management expense. Then you subtract the reimbursable and the non-reimbursable expenses from the effective gross income, and you get the NOI. Okay. Now, from this, they go through a calculation to calculate the terminal value, the sales value of this figure, and they divide it by a terminal cash flow, terminal cap rate, and they also grow the $8.5 million property at 3%, and then they take an average of these two, and they decide that the property would probably sell for about $9.7 million. And that's the figure you see there in what's labeled Exhibit 5. So now we're looking to get the IRR of the cash flows. So the cash flow out in the first year would be the $8.5 million you would have to pay for this building. And then the cash flow back would be the NOI, okay, because at this point we're looking before tax cash flow. We're not taking into account taxes, and we have no debt at this point. We paid outright for the whole $8.5 million. So we get back NOI, and the last year, and the fifth year, the last year in this case, we get back the NOI plus the $9,700,000 for selling the property. And if we find the IRR for that, we find that the IRR for this property then is 13.46. So if the required return is anything below that, we would accept it. If it's say 14, we would reject this project. There are other numbers that are looked at in making investment decisions. The capitalization rate, okay, that's just the NOI the first year divided by the acquisition price. So we look to see if that's in line with what other similar buildings are selling at. We look at the equity dividend rate, as they call it, which is the before tax cash flow divided by your initial equity. That's also the current return on equity. And of course, if you have no debt, it would just be the entire acquisition cost. The mortgage constant is just your debt service divided by the initial loan amount. Other financial ratios, the operating expense ratio, so the operating expenses to the effective gross income. The loan to value ratio, again, usually we want 80% or less. 80% to 75% is good in most large investment properties. The debt coverage ratio, net operating income divided by the debt service, and usually it's a minimum of 1.2, 1.3. There's 4 classes of real property that we've mentioned. Real estate held as a personal residence, and we've talked about that. Real estate held for sale to others, so you're really just a dealer. You're holding it just make a quick sale. Real estate held for use in trade or business, so you own real estate because you operate your business out of it. Or real estate held as an investment for the production of income property, investment property. And that's what we've been looking at here in this chapter. There are also different types of taxable income that you should be aware of, especially with real estate. Active income, salary, wages, bonuses, commission, and what we get paid for doing our work. Portfolio income, this is money we'd get from investing in stocks and bonds, interest, dividends, capital gains. And then there's passive income. This is rents from real estate is the big one, and also royalties from oil and gas rights. So why is this important? Well, important because passive losses cannot be used to reduce active or portfolio income. So if you have investment property, so you buy a small office building, rent it out, you buy a house, a 3-bedroom, and you rent it out, and so you have passive losses from that, say, because your payments and expenses that you have to do to fix that up are less than all of the expenses that you have, the interest payments that you make and the depreciation and so forth, so you end up with a passive loss. Well, you can't use those passive losses to reduce your active income, your salary and stuff like that, or your portfolio income, so income that you might get dividends and interest from stocks and bonds. Passive losses may be only be used to reduce other passive income. So if we've got another real estate project that's bringing in income, so that's passive income, and you have another real estate property that has passive losses, you can match those up against each other. And passive losses may not be used in future years or at the time of a sale. Okay. One only key thing is active participants, because if you have some activeness, you actually, hire someone or go down and do some of the maintenance on the property. You lease out the property. You deal with the tenants. So there's some activeness that you have in this as this piece of property that you also calling an investment. Then you can deduct up to $25,000 in passive losses against other non-passive income. Okay, so against your active income, against your salary, and so forth. Although this is subject to limitations. If your adjusted gross income hits $100,000, at that point it starts to get phased out, and by the time you hit 150, it is completely phased out. So you can start off doing this, but once you start making an awful lot of money, you can't do it anymore. Or you can do it, but you don't get the tax benefit of using those passive losses against your active income. So this is something to be able to understand, because I have recently been finding more and more, and it happened to me once, that you have all these losses that you're used to taking for tax purposes, and all of a sudden, because of maybe a large sale of another property, or some large commission you might get, or something else, a bonus, something else, it puts you into a higher tax bracket, and you end up not being able to take these passive losses. So let's add in a variable. Let's add taxes so we can find our after-tax IRR. So to do that, we need to figure out what our taxable income is so that we can figure out our tax rate. So usually the two things we need to subtract from our taxable income are depreciation and interest expense. So if we have debt too, we'd have interest expense. Depreciation is the building part of our property. We cannot depreciate land. Depreciate the building part of the property. And if we had any amortized financing costs, some points that we're amortizing over a number of years, we would also deduct those. That would be our taxable income. We'd multiply that times the tax rate, and we'd get our tax liability. Then that tax liability would then be subtracted from the operating income to come up with your after-tax cash flow. And that's shown here. We'd have our net operating. We would have to subtract our debt service, which would be the interest expense and the principal amortization, or just your debt service payment. And then you would subtract out your tax liability to get your after-tax cash flows. So interest expense and amortization, financing costs, interest, prepaid interest, those are all able to be written off. Costs of financing can be written off. Financing costs amortized over the life of the loan, so points can be written off. And unused balance taken in the year sold. And the depreciation basis, that's the original cost basis. That includes anything that it takes to get that property up and going. Less what we'd say was our land value. And then from that, we need to, when we're getting to the depreciation basis, that's our total depreciation basis. Everything to get that property up and running, or asset up and running, minus the land. Then we'll talk about the adjusted basis, where we take that depreciable basis and we subtract out all the accumulated depreciation up to that point. At this point, all we're going to use is a straight line. So we just take out the depreciation basis, that total amount we want to depreciate, and we will just divide it by the recovery period. Okay, we're going to use a mid-year convention, assuming that it's bought halfway through the first year and sold halfway through the last year. We're just going to take the value of that depreciation basis, the total amount to depreciate, divide it by the number of years of this recovery period, and get the annual depreciation amount. Some guides, and they go through in the book, which is kind of interesting, how these things have changed over time. Talking about what, a few years ago, what residential property could be depreciated at versus what it's depreciated now, and what commercial property and so forth. So it gives you a little bit of an indication that things do change over time. So although you may be able to take 39 years for commercial property, income property now, in a couple of years it may say, well, you can do it in 20 years. Okay, so it's just kind of an idea. Things have changed a lot in the past. That could always happen in the future. But for this point, residential income property, 27.5, and commercial, 39. And here's what I mentioned before, the adjusted basis. So we'll get the total cost basis minus any annual depreciation that we've had, plus any capital improvements. I did not mention that. If there were major capital improvements that improve the overall life or effectiveness of this asset, those would be added to it, and then we get our adjusted basis. So the calculation for the tax due on sale would be the net proceeds, whatever you're selling that building and land, the property for, minus the adjusted basis. That will give us our total taxable gain. Now, for our purposes, that's what we're going to use. Take that total taxable gain, and we are going to multiply it times the tax rate and get the taxes. Now, there are times that there are different rates for what's called the depreciation recapture and the capital gain. So they do show you this calculation. I'm going to say for us, let's just ignore it. Just sales proceeds less adjusted basis gives you your gain. Take that gain times the tax rate. That's your taxes. But if you wanted to find the difference, the accumulated depreciation, would be what you've totally recaptured in depreciation. You subtract that from your capital gain. If there's any extra, that's your capital gain. And so you may have one rate of taxes for your depreciation recapture and one for your capital gain. If you did that, you would have to change those two and separate them. But for our purposes, all you need to do is get the taxable gain and then calculate the taxes based on that. After-tax cash flow from the sale then, the gross sales price, less any selling expenses if there are any, so you have your net sales proceeds. Then if you're borrowing, you have to pay off the mortgage balance. That's your before-tax equity reversion. Then you subtract off your taxes, and you end up with your after-tax equity reversion, or after-tax cash flow. So now let's continue with this building example and look at exercises 7 through 9 and 13 through 17. So this uses the same example. We're still using it at this building, $8.5 million building, same 3 tenants, same NOI, but we're saying let's assume that we can finance 70% of this building. Okay, so $5,950,000 for 20 years at a 10% interest rate with a fully amortizing loan, and we'll have monthly payments. So the first thing we see that they do here is calculate what the payments this is an annual. Okay, so this is not an annual payment that you pay once a year. what they do here is your present value would be your $5,950,000. Okay, your N, because there's 20 years, is 240. 20 times 12. Future value is 0. It's fully amortizing. The interest rate is 10 divided by 12 because we're looking at monthly, and you compute the payment. Once you get that payment, you multiply that payment times 12. That's where they get $689,025. Okay, and since it's fixed rate, it stays the same year 2, 3, 4, 5. Okay. The mortgage balance, you need to find that by finding what are the present value of all the rest of the monthly payments for the next, let's see, it was 240, so 228 periods. Okay, and then you get the mortgage balance here, $5,081,543. Okay, now if we know that the mortgage balance is now $5,851,543, but when we started, we had $5,950,000. Then the difference between those, almost $100,000, $98,457, is the amount of principal that we paid down. So that goes into the principal. And then if we know our payment was $689,025 and the principal was $98,457, then the difference between those must be the interest we paid, which it is $590,569. Okay, so when you're filling in this table to use below, you have to be careful on how to get these numbers. They're not just saying for 20 years calculate the payment. They are finding a monthly payment and then multiplying that monthly payment times 12 to get the payment you have here, the $689,000. So you need to be careful on that. Okay. Then you do need to calculate what the ending mortgage balance is, but after that the calculations are easy because the prior balance, which in this case is the amount we borrowed, and this balance, the amount of that, is what you paid for the principal, and the difference between what you paid for the principal and your total payments is what you paid for interest. Okay, so once you calculated the payment, it stays the same for all the rest of the years. So the only other thing you need is the mortgage balance, and the rest of them are just subtractions. Okay, so now we see, well, here's the NOI that we had from previously. Again, same tenants, same operating expenses. We come up with the NOI, but now we have debt. So we have to subtract out the debt service to get your before tax cash flow, which they've done there. And that's in Exhibit 11.8. Then we're looking for what would be the cash flow from the sale. Okay, well, we previously decided that we were going to estimate the sale price at $9,700,000. Now we have to subtract out the balance of the mortgage at the end of the 5th year, because that's what we're looking at, 5-year holding period, and we get a before tax cash flow of $4,356,755. Okay, and then we think about what was the money that we put into this. Well, it was an $8.5 million building, but we borrowed 70%. So we only have to put down 30% of the $8.5 million, which is $2,550,000, which you'll see there in Exhibit 11.9 as the outflow of cash at time 0. Then we get the before tax cash flows from Exhibit 11.8, and to that, in that very last 5th cash flow, we add to that the before tax cash flow of selling this building, this property, and that would be the $4,356,755. And then we find what is the internal rate of return on those. And that works out to be 20.08%. And we call that the BT IRR, before tax IRR. In this case, it's on the equity. It's not on the entire property, it's on the equity. Okay, so that's the before tax. What about the after tax? Well, after tax, we've got the before tax cash flows. And we also... and that's in Exhibit 11.13. But now we need to get the after-tax cash flows. So in Exhibit 11.14, we start with NOI, and we subtract the interest and the depreciation. And again, the depreciation we get because they told us the building was some percentage, and I can't remember offhand what it was, but the building in the book will tell you was something, I believe it might have been like 60% of the total value of the property. So 60% of the $8.5 million. Okay, maybe it was 70%, 60%, some number. So that's the value of the building, and you need to take only that percentage because the other, say 30 or 40%, is the value of the land, and that isn't depreciated. Then once you get that number, you divide by 39, because we're assuming that it is a office building, so we'll have to use 39, and that becomes the annual depreciation, which you see there, 185,256. That stays the same all the way across. So now we have our taxable income. The net operating income minus interest minus depreciation. We multiply that times 0.36, and we get the taxes that we have to pay all the way across. Now to get the after-tax cash flow, we have the before-tax cash flow, which was calculated above in Exhibit 1113, and we subtract off the taxes we just calculated to get the after-tax cash flow. The loan summary is repeated here. Again, just make sure that you can understand and come up with all of these numbers so that when you do it on your own, you're doing it in the right manner. Next, we need to figure out the total capital gain. So we're assuming that we sold this property. The price appreciation for the property was bought it at $8.5 million, and we're selling it at $9.7 million. So it appreciated $1.2 million. And the accumulated depreciation, that was the depreciation, the annual depreciation times 5 in this case, because it's a 5-year holding period, is $926,282. So if we add those together, we get the total gain of $2,126,282. And we're going to just take a tax rate of one amount on this. You see, they divided this up and said that the appreciation part only gets 20%, where the accumulated depreciation or the recaptured depreciation has a 25% tax. But we're just going to do it once. But either way, either calculation, look at the way they did it, we get a total capital gain tax of $471,571. Okay, and we use that to subtract from our before-tax cash flows on the sale of this property. So we sold the property, take off the loan balance. Now we pay our taxes. We see an after-tax cash flow in Exhibit 17 that incorporates this. And then we find the before-tax and the after-tax IRR now with debt. We see it's 20.08 for the before-tax and 15.47 for the after-tax.